What if I told you that the bank didn't just make money off of your loan, they sold it behind your back and got paid again? Sometimes within days of you signing the contract. All right. Now, in this video, I'm going to be breaking down how banks securitize your loan, sell it as a financial product, and then try to collect from you like they never got paid. And I'll show you the laws that expose it. Okay. Now, I've studied credit systems, UCC laws, and loan securitization, and I'm here to show you exactly what happens to your loan after you sign it. First things first, thank you guys for watching this video. Everything that I'm about to talk about is not legal advice. This is only for educational purposes only. Do your due diligence. You dig me? Also, at the same time, if you're brand new, go ahead and subscribe to the channel. Turn on those post notifications because I do post daily content. All right. Secondly, like the video. You know what I mean? If you like the video, you put that investment in me, I'll continue to invest in you. All right. So we're about to dive right into it. My whole point of telling you what really happens when you actually sign the loan, because we talk about the fact that you are the creditor. We talk about the fact that you are the one creating that financial asset, but we never truly have a video specifically outlining what really happens, okay? How they make money off of it and how to be able to use this against them, okay? So when you get a mortgage, when you get a car loan, when you get a student loan, most people think the bank holds onto it and waits for monthly payments. But the reality is that's not what happens. What happens is your promissory note becomes an asset. And what is a promissory note? A promissory note is what they would call your loan agreement, okay? And the reality is that it's not a loan agreement, okay? It's actually a financial instrument. It's a negotiable instrument. You dig me? So let's just look at the definition of a promissory note real quick. When you go to Cornell Law, it says a promissory note is an unconditional promise to pay a certain amount of money to a named party or holder of the note, or to deposit that money as such person's direct, okay? So a lot of times understanding that when you create a promissory note, it's literally just a unconditional promise to pay, just like the dollar. It's very similar to the dollar, but it is worth more because when you create that promissory note and put your signature on there, the bank actually sells the note into a trust, fund, or even a securities pool. When we talk about mortgages, they sell it into mortgage-backed securities. When we talk about fund or bonds, they sell it to Wall Street and things of that nature. So when this happens, the loan is often securitized, meaning it is bundled with other loans and sold to investors. Now I want you to think, they got paid up front, but they still seem to keep you paying. Or as a matter of fact, they expect you to pay, like they actually loaned you money. But the reality is that they don't really loan you money. They are taking money from you already from the start, okay? So let's just talk about how they profit twice, okay? And this is me just explaining double dipping. I never truly dived into the aspect of double dipping or made a video specific to the aspect of double dipping, but this is exactly what they do. First, profit. Your signature creates the credit, all right? The bank deposits the note and books it as an asset, okay? The second profit, the bank sells the note or uses it to create mortgage-backed securities, all right? Or asset-backed securities, or even credit default swaps. So MBS, ABS, or credit default swaps. So that's the second time that they get paid. And then the third layer of them getting paid is you keep paying monthly payments even though they already got paid from those first two times. Sometimes they even get paid through insurance or bailout funds to cover default. So let's just say when you default, that promissory note or that debt was insured, okay? So essentially, you are paying for a loan that's already been paid for. Now, if you don't believe anything that I'm saying right now, I would just direct you to the book, to Modern Money Mechanics. But we're going to tap into a couple of laws, a couple of things that essentially breaks down, or not only breaks down, but affirms everything that I'm talking about, okay? My goal here is not to give you any false information and not because I'm just going to show you the information that is literally attainable online. The only thing is, or the problem that we have is, this information has been out there for years, but the reality is people don't like to read. One of the least used skills since we left school was the ability to read. Okay? If you can get to the point where you're reading, you're probably not going to be affected by a lot of the BS that these banks will feed you. Okay? So here's what they don't tell you. You're not told that your loan is being sold. That's number one. Okay? And that's a violation. We'll talk about that. Number two, they never asked you for consent. The thing is, when they decide to use your credit in that way, they must ask you for consent, and given the fact that you are the original creditor. I talked about this in my last video. Third, there's no disclosure of profits made on your signature. So that is another violation. The fact that they don't disclose this information to you, which is essential according to the Truth in Lending Act. All lenders should disclose any and everything about your loan, even if it got sold. And then we dive into you only being treated as a debtor and not the funding source. And essentially, they just pocket the whole spread of money. You have to think, God dang, man, they've been running this game on me for years. All the loans that you have gotten, credit cards, auto loans, mortgages. And then I haven't even spoke about the fact that there's fractional banking. So when you actually apply for something, they get 10 times the money, according to Modern Money Mechanics, the book of banks. Okay, so let's just dive in and talk a little bit about the laws that back this up. So let's just dive straight into Article 3, negotiable instruments, where essentially this is the Uniform Commercial Code aspect of talking about negotiable instruments. If you want any and everything about negotiable instruments and what a negotiable instrument is, are things like that are used to pay for loans, that are used to pay for debt. Let's dive straight into it. Okay, UCC 3-301 is person entitled to enforce the instrument. Okay, person entitled to enforce an instrument means the holder of the instrument. Also a non-holder in possession of the instrument who has the rights of a holder, and a person who is not in possession of the instrument who is entitled to enforce the instrument pursuant to Section 3-309 or 3-418D. A person may be a person entitled to enforce the instrument even though the person is not the owner of the instrument or is in wrongful possession of the instrument. So thinking of the definition of, people can look at the person entitled to enforce and they may have a misconception of what it means, but it's really in the name. Okay, typically the person entitled to enforce can be that holder. Typically the person that's entitled to enforce could be the person who has rights of an holder, but they may not essentially hold or have it in possession. Okay, maybe it was transferred. And then we dive into someone who lost the instrument but can still prove they're entitled to enforce under specific conditions. Okay, now just to kind of break this down in layman's terms, a person or company that has a legal right to collect on a debt or enforce a contract. Okay, like a loan or a promissory note. Okay, but it's not just enough for them to say that you owe us. Okay, they must legally prove that they own the note, have possession of the original in most cases, and have a legal right to enforce it, either it's through transfer, endorsement, or assignment. So let's just dive into the next section, which is UCC 3-302, which talks a little bit about the holder in due course. Okay, the holder in due course means the holder of an instrument. The instrument, when issued or negotiated to the holder, does not bear such apparent evidence of forgery or alteration, or is not otherwise so irregular or incomplete as to call into question its authenticity. Okay, the holder took the instrument for value in good faith. Okay, without notice that the instrument is overdue or has been dishonored, or that there's been an uncured default with respect to the payment of the instrument issued as part of the same series. Okay, so I can read this whole thing, but tap into this, read it. It says notice of discharge of a party, so on and so forth. But it breaks down what a holder in due course means. So if you ever had a question of what a holder in due course and what you should be looking for, then tap into this section right here. Okay. Now here's the thing: most debt collectors or third-party companies do not meet this standard because they do not have the original contract or note. They cannot prove that they was legally assigned the debt, and they don't have a proper chain of custody or transfer of rights. So this is when you start to challenge whether they are the holder in due course by asking these specific questions. So they may not be the person entitled to enforce the instrument, but given the fact that you signed it, you are a person that is entitled to enforce. Okay, so typical questions that you can ask them is say under UCC 3-301, I demand you to prove that you're the person that's entitled to enforce the instruments. Okay, so this is just under the Uniform Commercial Code in regards to negotiable instrument, talking about enforcement of instrument, negotiation, and transfer. And you can gather a lot of information. I may choose one of these one video and dive into it on a deeper level. Notice of breach of fiduciary duties, enforcement of lost or destroyed or stolen instrument. Okay, so obviously if they sell the instrument and they give away their rights, then they don't have a ability to collect on the debt. Okay, but then we dive into Article 9. Okay, and Article 9 is about secure transactions. Typically most of the loans that have a piece of collateral attached to it is considered a secure transaction, but you can ask them for the request for accounting request regarding a list of collateral or statement of account. Okay, so you have a right to request a full accounting of your obligation. Okay, and you can legally ask where your payments go and who is collecting that. All right, all of this under the subsection gives you the ability to request specific information about how the money is being moved as it regards to your loan. See, most of us don't utilize this to our benefit, because if we ask them for this information, we'll be able to clearly see when they have where the money is going. That's one. And also at the same time, if money has actually came in. Okay, so if you give us some documents that don't essentially show where the money is going, but also at the same time, if money has came in, then there has to be some type of fraud. There has to be some type of forgery. If you can't give me these items, then there's something that you're not telling me, and that's just a direct violation of the UCC, of also the Truth in Lending Act, and so on and so forth. And that's what we're about to talk about. It also says that they must comply with this request within 14 days after the receipt. So they have a duty to respond to these requests. If you ask for these things, then it is their duty to respond to it. If they don't, if they're any day past 14 days late, then they are violating your rights. And that's the beauty about it. It's written right here. So if they can sit there and tell you, oh, well, we don't have to do this, or they can ignore you, but anybody who reads this for themselves can clearly see that it says that they have 14 days. So if they ignore you and it's past 14 days, well, you know that they're violating the UCC. Okay, then we talk about the Truth in Lending Act, 15 U.S.C. 1601, congressional findings and declaration of purpose, or as a matter of fact, the whole Truth in Lending section. Okay, but specifically under the Truth in Lending Act, it says that it is the purpose of this subchapter to assure a meaningful disclosure of credit terms so that the consumer will be able to compare more readily for the various credit terms available to him and avoid the uninformed use of credit, and to protect the consumer against inaccurate, unfair credit billing and also unfair credit card practices. Okay, so the thing is under the Truth in Lending Act, I mean, this is the truth in lending. So when I talk about the truth in lending, I'm talking about the fact that they have a requirement to provide full disclosure when it comes to your loan. Okay, quote unquote, when it comes to your contract, they must provide full disclosure. So not only can you ask them for all those details listed in the UCC that is a part of the Truth in Lending Act, but there are violations put in place when you do not follow that direction as a lender. Okay, So essentially, they must provide full disclosure of the terms, charges, and parties involved in the financing. Okay, it's important for them to let you know who the parties that are involved in the financing. Okay, because the failure to disclose the sale or securitization can be argued as a violation. So when we look at back at it, okay, we can dive into the fact that we can go to the disclosure guidelines, okay, but we can just go straight to criminal liability for willful and knowing violation. So it's actually a criminal offense if they ignore you when you are asking them questions about the contract, okay? Because they will be misrepresenting. They will be doing something fraudulent if you ask them a specific question and they don't give you that answer. You know what I mean? So that's under the Truth in Lending Act, 12 USC 1601 all the way to 1616. Okay, so if a person wanted to learn, so when it gets to the aspect of you challenging the company, you may send your negotiable instrument first, boom, then they try to say, oh man, well, you can't use that. So then you want to go and challenge the actual contract itself. You want to challenge their jurisdiction or their authority to not accept certain things. But I'm jumping the gun a little bit. We'll talk about that in a second. So then I want to talk about RESPA, which is 12 USC 2605, and I'll pull up a different section to talk about RESPA. Okay, RESPA is the Real Estate Settlement Procedures Act. It's a federal law enacted in 1974 to protect consumers in real estate transactions, requiring lenders to disclose settlement costs and prohibiting kickbacks and unearned fees. Okay, I don't think this just applies to real estate. Okay, but it's called the Real Estate Settlement Procedures Act. Okay. Now, part of this, okay, and this is particular, let's just say this is particular for mortgage loans, okay? Under RESPA, it requires disclosures when servicing or when it comes to the ownership of mortgage loan changes, okay? So if a debt was sold and they didn't notify you properly, that is another violation of the USC code, okay? The whole aspect, I'm telling you all of these things so that you understand what to look for, what to ask for, and it's just as simple as them violating you for not providing certain documentation that needs to be given to you. Okay? And then we want to talk a little bit about just negotiable instruments so we can kind of push through this. Negotiable instruments, the truth in negotiable instruments, if your note has value and they sold it, you can argue that your consideration funded the deal and not theirs, okay? So the thing is in context of negotiable instruments, truth or truthfulness refers to requirement that the instrument must be unconditional, unambiguous, and clearly state the promise or order to pay a fixed amount of money. So it says that a negotiable instrument is a promise to pay, which is considered lawful tender, okay? When we dive into the definition of tender, not tender, it says tender is to unconditionally offer money and performance to meet an obligation. So again, it breaks it all down on the law, but a lot of times we'll say, oh, this stuff doesn't work, or this, that, and the third. What is the point of me reading this if it doesn't work? You know what I mean? So again, for those of you guys that are truly tapped in and on a frequency that I am on that says, okay, damn, this is what I needed to be able to take action. Perfect. All right. Also, at the same time, if you got this far, 20 minutes into the video, go ahead and like the video. Okay. Go ahead and subscribe to the channel. Turn on those post notifications because I will consistently keep dropping these games, even if I have to repeat certain laws so that you guys can be able to understand it on a deeper level. Even if I have to do this to be able to, maybe you didn't catch it in the last video, but this will be the video you catch it. Okay. So now I want to talk a little bit about what to do if you want to be able to take action on these things. And a lot of times that is the biggest problem, right? We don't know how to take action on these things. Yes, Nicholas, you can tell me all of these laws and things in that nature, but I don't know how to take action. Okay. So before I dive into this, make sure you hit that like button. Okay. So let's dive into it. Here's what you can do. First thing you want to do is you want to go ahead and send in a qualified written request. What is a qualified written request? Okay. It is a written correspondence that you or someone acting on your behalf can send to your mortgage servicer. Okay? Now, not just the mortgage servicer, but you can send a similar letter to anybody you have a loan through. Now, it says that in the QWR, these are the things that you want to ask them of. Okay? So, or these are the things that you can ask them. Now, this is specifically, it says to specifically send this in regards to your mortgage, things in that nature. But the things that you can request for clarification, documentation regarding the servicing and ownership of the mortgage loan, okay? Please provide the following: a full itemized accounting of the loan from the original, from origination to present. Number 2, the name, address, and contact info of the current creditor or note holder. A certified copy of the original promissory note, including endorsements and assignments. Proof that your institution is the legal servicer or agent of the creditor. Disclosure of whether the loan was sold, securitized, or transferred. A copy of the pooling or servicing agreement. A complete transaction history from the date of origination to now. Any 1099-A or 1099-C filings related to this account, and a copy of the original closing disclosure or HUD-1 settlement statement, and proof of lawful consideration exchanged at the origination of the loan. Okay? So it says please respond in 30 business days. You can give them 14, right? But the whole aspect of this, and I'll make sure to include this in my complete debt guide. So if you want this specific letter, go ahead and grab the complete debt guide. It's only $47. The value is going up every single day, so expect the value to go up. And also at the same time, if you do grab it, then you're going to be able to use it, be able to resell it as an affiliate. Okay, so you want to write a QWR and you want to request those things. Remember, it doesn't have to be special, perfect. If you write a letter with your name, letterhead, and you direct it to the right person, and you ask specific questions and you sign it, then it is a formal written request. Okay, it doesn't have to be special. Okay, and also at the same time, you can demand this under UCC 9-210. So you can add those things that is in UCC 9-210. So make sure you ask for the note, securitization info, transactional history, challenge the collection if the party is demanding payment that they can't prove. So under 15 USC 1692G, when you do this stuff and they ignore you and decide to send you a bill, then you want to send them a debt validation letter. Okay, you can also use conditional acceptance to force them to admit what they did with your loan. And number 3, you can leverage the truth in lending violations to file a dispute or rescind the agreement within 3 years for some loans. Okay, so we talk about, we'll have a separate video talking about the right of rescission. As a matter of fact, there's already a video right above. I'll go ahead and link it right here or link it down in the description. So if I don't do it, y'all can remind me in the comment section. But obviously, these are some things that you can do. I gave you those, that the application of these things, the strategy behind this. And I helped you understand the aspect that they turn your signature into a product. Okay, they make you pay twice, but once you understand the system, you can challenge debt and demand proof and hope they never ask for it. Okay, never ask for the debt. And also at the same time, they really don't want you to do this. They don't want you to know this. And yes, they're going to give you some pushback. Yes, they're going to make it hard for you to actually do these things. Yes, you're going to have to be willing to go through the full process. And this is why I tell people it's super important for you to tap into the law, tap into the information for yourself, do your due diligence, get confident with the information so that you know exactly what to get. You know exactly what they're supposed to be giving you. Also at the same time, you know what to ask for, okay? You know what should go and what should not go. You know how to do your part, because when you do your part, when you go in court and you show that you have done your part and they didn't do their part, forget how much you owe. Forget what they claim that you owe. If you try to do everything in your power to get them to prove that you actually owe them and they decided to ignore you, they are hurting themselves. Okay? So, if you want that UCC 9-210 template, If you want that qualified written request that I just showed you, it will be in the complete debt guide. Okay, anybody who taps into the complete debt guide will be able to resell it as an affiliate. Okay, go ahead and tap down. That link will be in the description. Okay, for all my debt people, the complete debt guide is where you want to go. If you want that one-on-one mentorship in regards to credit repair, business funding, or setting up your online business, if we're talking about an online business, you should already be in a space or in a motion of online space in order for you to tap into that aspect. If you're a beginner, I wouldn't recommend tapping into that one-on-one. Okay, but when it comes to credit, when it comes to funding, tap into that one-on-one. Book a call down below, get a free one-on-one, either speaking to me or my team, and we'll be able to see if you're a fit for my program. Okay, also at the same time, if you want to challenge a debt collector or a servicer and you don't want to learn any of this stuff, you don't want to write your letters or nothing at all, down below is Solo Suit. You can pay them up front and they'll pretty much take care of most of the dirty work in regards to negotiating with a debt collector. And then lastly, if you want to follow me on Instagram for daily credit content, daily legal strategy, go ahead and tap in with your boy at biz.nick. And also at the same time, if you found out your loan was sold without your knowledge, drop down in the comment section. Let people know how what your experience was. And if you made it all the way to the end, comment the word discharge so that I know that you're a real one. Thank you guys. I love you, and I'll see you in the next one. Ha!